I made over $20,000 trading the SPX by simply looking at previous day highs and previous day lows. Now, you may think that that is making things too simple, but I am here to tell you that trading does not need to be as complicated and difficult to understand as you see online. Most traders struggle because they try to overcomplicate their entries and exits. They struggle to know which levels to look at and how to read the price action at these core inflection points. In today's video, I'm going to share with you the simplified things that I looked at today to make $20,000 on the SPX and prove to you that this doesn't have to be overcomplicated. I encourage you to stick around towards the end of this video to soak up the information, because this could very well be that video you need to simplify your trading and take that step towards profitability. If I can get a little fail candle here at 59.69, I would look short. Need to see a fail candle here. SPY is rejecting previous day lows. ES is rejecting previous day lows as well. I'm short. Stop loss over previous day lows on the SPY and the ES. Break and retest previous day lows. Stop loss 59.73, targeting 53. This is the trade idea right here. There it is. There's your single candle. More off. Into targets of 53, up 25%. I'd actually be intrigued if you want to get really spicy, you can look to see if there's a long off of previous day lows. But again, that's you trading inside of the channel, so just make sure you know that. That could get spicy though. But now that you're back over previous day lows on SPY, I would no longer be interested in shorting. That is no longer interesting. You are back above it. So that short interest is gone. If anything, a reclaim ripper is interesting. Possibly what you're about to see here. If I can get one more pullback on the SPY towards previous day lows, I may try that. Keep an eye to see how the ES builds above this previous day low again. Right here in this SPY. Could be interesting. I'm going to take a little bit of a long here, guys, on ES. I'm going to take an SPX long. Stop under 59.71. So I'm longing above previous day low. Risk is below previous day low. QQQ just did a break and retest of previous day high. If that QQQ holds previous day high, then this ES should defend that low and continue towards, I think, 6,000, 6,008. I think that's the target. So the reason I'm liking this, just to sort of think through it, I like how you failed underneath the previous day low, got interest in the short side, and then ripped them, right? I love that. You got under the lows, you reclaimed it, and you ripped them, right? So everyone short is like, oh man, this isn't looking good right now. Here we go, 36% SPX. Absolutely beautiful day. Good reads on the market. Good long on the reclaim ripper. Sitting in that trade up around 99%, 100%. So today, this is the S&P 500 ETF on the 1 hour chart. On Monday of this week, we saw a very clear high get formed around the $593 per share level. Now we can see after that high was broken, we just sort of traded sideways in this random channel, not really hitting any type of major rejection point and never pulling back to any type of previous high. So we basically just traded sideways and really didn't touch any major inflection points. And so what we need to do is we need to wait for the market to push up into a major rejection point or pull back into a major hold level. And it just so happens that today we saw the market pull back towards a major previous hold level and have a very strong reaction back to the upside. Now, for those of you that may trade futures or want to use this type of education towards a futures funded account, whatever it might be, we can fact check this on the S&P 500 futures as well. We had a very clear high from this Monday on the S&P 500 futures at 59.55. Today, we saw the market pull back into that level and have a very strong reaction back to the upside. This is a massive move today, and SPX contracts ran over 100% by simply looking for this previous high to turn into a new support level. What I like to call it, a break and retest long entry. Now, I didn't just long at that low. There was something else that I wanted to see happen before gaining confirmation to take this entry. And you may think that this is even more simplified, but guess what? It works. And I made $20,000 doing it. So that right there should debunk the fact that things need to be overcomplicated. You can see on this chart, if I go back to the S&P 500, you have a green and red line that is sitting on this chart. And that right there is a study that I use that automatically maps out the previous day high and previous day low. It puts a level across the chart on the following day, where that low was of the previous day and where that high was on the previous day. So if we look at this chart, when we were pulling back into this previous high, that also means that we broke below the previous day low. Right, if our previous day low here, in this case, was right around this 595.50, you can see this was our previous day low, and that is where that red line sort of shows up on my chart. So if we're pulling back under that previous day low, then I don't really want to be longing this key level down below. So if we have broken down below that previous day low and started to trade back towards this previous high here, I'm not going to be interested in longing down in this area. Why is that? The reason I'm not interested in longing down at this exact low is because if the market does bounce and then turn the previous day's lows into a rejection point, then I could be on the wrong side of this market. So what I'm looking for is the market to reclaim that previous day low. So if we break this down into a 5-minute time frame, you can see exactly what I'm referring to. This is that previous day low that is marked as that red line on my chart. So I have that automatically set every single morning, making sure I know if the market is trading above or below the previous day's low. Now you can see that we did fail under that level, and actually I took a SPX put option today off of that level. If I go down into the 2-minute chart, right here you can see the S&P 500 broke below that previous day low at 595.50, failed below it, turned it into a rejection right here, and continued to the downside. This was actually a put option that I traded today and made a very nice 20% on. It was a short-term scalp. Now, the reason I took that trade-off is because we were trading down into that more major 593 level that we just talked about. If we go back to the 30-minute chart, I will remind you of what that level was. You can see right here, that was this major previous high, and I knew that if we were trading down into that, there could be buyers waiting to push this back to the upside. So I didn't want to get too aggressive shorting down into that major low on the S&P 500 ETF at $593 per share. So before I was interested in longing this low, understanding that buyers were here, what I was looking for was a reclaim of the previous day's low. So if I go down into the 2-minute chart and show you exactly what I was looking for, you can see here that the S&P 500 failed below the previous day low at this 595.50, right? Failed right here, started the trade underneath it. That would technically be a bearish thing on the market. We saw failures underneath here again, and sellers were starting to take control, keeping the market below the previous day's low. Again, a very simple thing to be looking at. However, I figured that sellers might get trapped here trying to short that because of how major our demand was down below. So what I was waiting for was for these sellers to get trapped, the market to get back above this previous day low, turn it back into a support level, and then look to long the market back higher. Now, the concept here is that if there are short sellers looking to trade this market lower under the previous day low, if that major demand down below is stronger and those buyers end up holding this market up, and that market starts to get back above that previous day low, then these shorts would start to become under pressure and potentially start to exit their positions. So what I was really looking for was a short selling rally back to the upside, key demand holding the market up, and short sellers getting trapped looking for that previous day low to stay as a rejection point. So we can see right here around 1024 that the market went ahead and got back above that previous day low and started to push back to the upside. Now, I did not simply just look to long the market once it got back above. I need to look for a break and retest long entry. So we got the breakout, but let's wait for the retest. And let's go candle by candle to see if this happened. Here is our pullback candle. The next candle that follows is a breakdown back below it. So the retest didn't stay true. We needed to see this level hold on this 2-minute candle. Let's go to the next candle. You can see that it went ahead and it failed. It did not hold back above that previous day low, and there was no trade initiated at this point. If we keep going, we can see that that reclaim came in once again. It held right here, and you can see as we push forward, a big push comes to the upside. Now, I didn't take this entry, and it was a little bit too quick, so what I was looking for was for the market to come back down into that previous day low and give me an entry point. We can see over the next few minutes, the market pulled back, and right here, I went ahead and I executed my entry point. I took my long with a stop loss below that previous day low, risking about 50 cents on the underlying equity, which is a very small amount here on the S&P 500 ETF. It would have been roughly about a 5-point risk right here, back down into 59.75 for a target up to that 6,000 supply, which was right around a 20-point reward. And that right there, I would say, is a fantastic risk reward of around 4-to-1. So I had a very clear stop loss level, and I had a thesis behind my trade. I knew that the sellers that were shorting underneath previous day low were starting to get squeezed out. I knew that we have reclaimed back above that previous day low. And on top of that, I knew that the major demand down at 593 was also holding this market higher. So I figured I could take my shot, risk that 50 cents. If we did fail back below the previous day low and reject it, I would have taken my loss if that thesis would have failed. However, you guys can see after we took our entry here, risking about 5 points, we got a very strong move back to the upside towards that major rejection point from the pre-market where I was exiting my position for a beautiful risk-reward trade. On the S&P 500, you can see that this was a very clean little break and retest where we took that long, risking about 5 points into that 59.75, which gave that very clean 20-point move up into this major high, which was the exact rejection point at 6,008 on the S&P 500 futures. So let's recap. What did I look for to take this trade? Everything I looked for was very simple. I looked for the market to hold a major previous high. That major previous high was right here at $593 per share. I saw that the market had broken below the previous day low, and if we were to reclaim that level, we could see a short squeeze rally. So we saw the market move down into a major previous low, started to see buyers step up. I allowed the market to pop back higher before taking my trade. I did not anticipate that this was going to hold on. I actually allowed the market and let the price action show me that buyers were present. Now, I knew there was a key inflection point at the previous day low, which was $595 per share, $595.50. Once I saw the market get back above the previous day low after holding above the major demand, I figured that any short right here would be underwater, and if they start taking their positions off, we could squeeze back to the upside, giving a fantastic long opportunity. Now, just to put a little cherry on top, I want to show you exactly how this worked to the downside as well today on the S&P 500 using the green line, which is the previous day's high. You can see right here that the market went ahead and got above that previous day high and tried to hold above it for about an hour of time. Now, eventually, we pushed higher into a major rejection point, and I will show you where that comes from. If we go to the 30-minute chart, we can see there is a very clear 6,008 major rejection point on the S&P 500 from last week. So that is a key level and an inflection point that must be on our charts. This is not difficult to find. This is a simple concept. It is right here at the previous rejection points. So if we go down into that 5-minute chart, we can see that the market simply moved into that level once again and failed just like it did last time. Now, did you have to go ahead and take that short right at that high? No. Where could you have taken that short? Well, let's go down to the 2-minute chart and show you exactly how the same concept applied for both previous day high and previous day's low. So remember, I took my long above previous day low, trapping shorts down below. Look what happened here. You could have taken a short under previous day high, trapping the buyers above. And look at the break and retest rejection that came in off that trade. That right there is well over a 100% SPX or SPY put option on 0 DTE contracts, simply using previous day highs and previous day lows, while understanding major supply and major demand levels. Look at the traps that were set both here as well as here today, and knowing how to react and trade with confidence at these inflection points is key.